Okay, and in this week's podcast episode, the topic is what is the difference between investing and speculating? And I'm thrilled to introduce Ivan Illan, founder and chief investment officer for Aligne Wealth Advisors and Investment Management. He has directly raised and managed over $1 billion in assets from both institutional and private retail clients. Ivan is also a best-selling author of the book Success as a Financial Advisor for Dummies and an official member of the Forbes Finance Council. Ivan, thank you so much for being on the show. I'm so thrilled. This is going to be fabulous. We met probably only several months ago, right? And we're like kindred spirits, Ivan. This is fantastic.
Well, it's great to be with you, Richard. I think you're such an incredible professional, so brilliant, and I'm already a big fan of yours. So I'm absolutely thrilled to be with you today and to talk about this very interesting subject, which I think a lot of people have a sense about, but it's very different when you spend some time actually thinking through the subject matter in this way.
And ditto to your kind words and sentiments, Ivan. We've had some wonderful conversations, and there's definitely kindred spirits. So thank you for that.
For sure, of course.
All right, so we're going to get started with foundational understanding. So how do you define the difference, Ivan, between speculating and investing?
You know, I think many people hear the word speculator and an image comes to mind, and people think of investor and an image comes to mind. And so, and I'm a very visual person. So when I think of investor, I think of Warren Buffett.
Yeah.
Or I think of Peter Lynch, or someone of that like caliber and that kind of weight and gravitas, and long term and old.
Wisdom, I think is
okay, wisdom. Well, you're very generous, Richard. Yes, wisdom. And when I think of speculator, I think of a younger generation. I think of crypto bros, for example. But I don't think that is necessarily correct. I don't think that investors are only one type of, they don't look and act and behave in one particular way, and neither do speculators. I think there's a lot of nuance to both of these characteristics or styles of capital allocation, and one is not necessarily better than the other, but it just requires really understanding where the divide really is. And so you've asked for a definition or kind of understanding what the difference is. I would say very simply, investing takes an approach to allocating capital that's based on a specific idea or thesis of how something will play out over time. And speculation is less about a specific thesis and more about perhaps market dynamics, maybe more subject to supply and demand, certainly has more of a risk profile around it. Much more volatility that you would expect, but also much more potential for total loss of capital. Whereas investing, even though all forms of investment are at risk of losing capital, investing over long periods of time are perhaps less prone to the risk of total loss of capital, especially when you think about, putting money into an index fund. I would venture to guess that no one in their right mind would believe that the S&P 500 index will go to zero value over the next 10 years. Now, of course, if that did happen, we would have many more problems than someone's investment account going to zero. You would probably have complete lawlessness in society. So I do think it is, it's almost overly, sort of talked about that all investments have the risk of loss. But boy, there is a very, very big difference between total loss of capital and intermittent fluctuations of the value of an investment. And I think this is a very important divide that really separates speculators from investors, and also what separates good investors from bad investors is just really understanding the variableness of prices in an otherwise decent investment. But it is subject to fluctuation over time, and obviously that has an impact on the behavior of that capital allocator and their control over their behavior. But certainly understanding that difference from the get-go is important for an individual or a business, or anyone that's allocating capital. Understand the approach that they're taking, the mindset that they're taking as they enter into the transaction.
Yeah, got it. Okay. You've hit the R word a few times here. I'm going to come back to risk tolerance for sure in this conversation. But so what kind of mindset differentiates a speculator from an investor, Ivan?
Speculators are definitely, they're wild people. No, I'm just kidding. They're the party people, they're the exciting people in the room. No, that may be the case actually, but no, speculators, I think, have more of a short-term mindset, generally speaking, because no one can really see into the future too far in advance. I think there are ways to have high confidence or develop high confidence bands on the likelihood of a certain outcome in a short period of time. And by the way, there's a lot of study around this with market technicians. I mean, there's an entire field of study in finance that's based on technical analysis.
Yeah.
I'm not a market technician. I know what it is. I do reference it in making investment decisions, but I also know that it is very suspect. And it's not really a pure science, although a market technician would, of course, argue against that and say it is a very accurate science. But I also think human beings like to see patterns in things that don't necessarily exist. And that's part of the human condition, is we like to make order out of disorder. And so I do see market technicians kind of doing that, and then they even have, cool terms for it, like head and shoulders, or, inverse head and shoulders, or I mean, there's a lot of, figurative references. But so I kind of look at, market technician work as speculation, but a market technician wouldn't necessarily say that it's speculation. They would call it a form of investing. So generally, then I would have to say that a speculator is just looking at shorter term opportunities that could be realized maybe in a month, or maybe a day, maybe an hour,
Yeah.
maybe 12 months, but maybe 12 months is too short for some speculators. Maybe they give it 3 years for something to play out, especially when you get into startup companies, venture money, and you could actually say that all venture capital is populated by speculators. They're all just hoping that the 1 out of 1,000 works in their favor, and they spread the money around to as many opportunities as possible. And that is really the true nature of speculating. You're kind of playing the odds. Speculating could be seen as, akin to going to Vegas and just putting it on black or putting it all on red, or if you're really daring, putting it all on green, if you're at a table that has the green. So it is, I think you have a sense of what speculation is. And then, an investor is someone that, and I think Warren Buffett probably said it best, where if you could make an investment in something and put it in a drawer and close it for 5 years and not open that drawer for 5 years, then that's the mark of being a good investor. Which I don't really agree with that. I mean, it's nice to keep tabs on an investment because something can go horribly awry in a 5-year time frame. So you probably don't want to be that, but I understand the intention that he's trying to communicate behind it. So maybe the main differentiator is time, but like I just referenced with a venture capitalist, they can have many years of waiting for that opportunity to come to fruition. So time isn't necessarily a perfect characteristic of one versus the other. And I think this is the point of what makes this subject matter so interesting.
Yeah.
Because you could be a little bit of both when entering into any kind of transaction or investment or capital allocation. But it's just important to identify what it may be more of, and how are you evaluating the investment more as an investor that has a time horizon that is maybe 5 years, maybe 7 years, maybe 10 years, to be able to sit on your hands and wait for a result? Or are you really looking for a result that materializes in a few months? And certainly, as someone that is a capital allocator, that is making global macroeconomic assessments on a forward-looking basis of risk, assessing risk on a forward-looking basis, I have to experiment as well within my own framework of capital allocation decisions, and so I will do that for a certain allocation of my own saved money that I'll make my own investments. I don't want to gamble or speculate with clients' money. So if I'm going to look to challenge my conventional thinking or discipline, I'll experiment with money that only is I can lose my own money. I don't want to lose somebody else's money. But I have been in situations where I will consciously enter into a speculative investment with a thesis of why that investment would do well. And the investment could do extremely well in a very short period of time. However, I don't want to pay taxes based on ordinary income rates, because when it's less than 12 months holding, you pay ordinary income rates on your capital gain. And so I didn't want to sell it. Well, I should have sold it, because the thing then collapsed after, another few months. And now I'm stuck in the position for, it's been 3 or 4 years now. But that's the point, is I afford myself the space to learn who I am as an investor or as a speculator, so that it actually makes me a better capital allocator in the work I'm doing professionally. I think you have to challenge your own self, and the only way to really do that, by the way, is to put real money into real things. I think there's just too much fictional portfolios that are run that people can develop, false confidence around. There's nothing like putting actual money into something and praying to the heavens that it works out. And that's a real test of your own resolve and your own discipline. And certainly I do that as a way to challenge this conventional thinking. Am I really thinking about this strategy more in a speculative way or in an investment way? And And it's not so easy to know that necessarily when you go into it.
Definitely. So let's unpack a couple of things. A day trader. Is a day trader always a speculator?
I mean, you would think it's an easy question to answer. You would think it's an automatic, absolutely, a day trader is a pure speculator.
Yes.
But I would say that there are absolutely, I would say, instances, particularly when it comes to a a technical analysis professional who is a market technician, who is, in their mind, they have very specific thesis and rationale as to why they're entering into a position at a certain point and then exiting that position at another point, and it's all mapped out in advance. I would be hard pressed to call that speculation. I would say that's a thesis. They have an idea, they have a roadmap, they have a plan. It may be on a very short scale, short time frame,
Yeah.
but there is there is a thought behind it. There's a plan. Now the plan could be totally, blown up 2 minutes into the trade, but at least they entered into it with this plan. And of course, if they've done, their homework enough, they maybe have a high likelihood of some success with how that plays out. And even, when I started trading at 13 years of age, so I did a lot of day trading, and we didn't have cell phones back then. We had pagers. So I would get paged by my broker, and I'd have to go to the payphone in the hall at my high school in order to make the trade. And then I go back to the class, and, the teachers and classmates got a lot of a kick out of that. But I was very aware that it was really speculating to a certain extent, even though at that time in my life, I was really doing more technical analysis and market technician work, which I didn't know that's what it was called. But I would use Lotus 123. This is before Excel. And I would print out pieces of paper that would have price on one piece of paper, and then have volatility, volume on another piece of paper. And then I would hold those two pieces of paper up to the light to overlay them, because you couldn't do that very easily with these programs back in the day. And then I would have an entry point, and I'd figure out an exit point. And so it's kind of crazy, sort of to intuitively kind of see, where there may be opportunities. But was that speculation, or was that really investing? Was I developing more of a thesis and a real plan around entry and exit? I don't think you can call that speculating when you develop a real plan around your entry point and exit point. I think it starts to look more like investing, even though it's done on a very, very small scale and very protracted time frame.
Interesting. Ivan, let's make a few distinctions, because you mentioned Warren Buffett a couple of times. And so in terms of, and you could use Warren Buffett example or Ivan's principles, when we talk about investing, there's certain things, if you read any of his books or text or whatever, the way he invests, if you can give an example of, maybe 3 to 5 kind of points that a Warren Buffett or one of the founding fathers would use when they're looking at a really good kind of stock or instrument investment, compared to, a speculative kind of approach, right? I mean, you talked about
Yes.
technical analysis. So it'd be interesting I think for the audience to kind of just get a few distinctions. I mean, pick the ones you want. I'm not
Oh,
saying it has to be
definitely.
Warren Buffett, but
The first thing that comes to mind is earnings.
yeah,
So if a investment opportunity,
yep,
whether it's a company, real estate, doesn't matter what it is, if it has earnings, profit, actual net income and profit, you have more information than you really know what to do with, essentially. It's I think, a fundamental difference between being an investor versus a speculator. A speculator will look at an unprofitable or no income investment opportunity and say, I think that this will become profitable at some point, and therefore I'm going to buy in now. And when it does become profitable, wow, this business will be worth so much more. And in practice, you actually see that work out usually very badly for investors because they buy so early on in the profit phase of a company, that it may take 10, 15 years before it's actually becoming profitable. And there can be quite a bit of volatility during that period of time. And then even when it becomes profitable, then everyone is not excited by the opportunity anymore. And they sell it because now you can see that the earnings growth isn't that special, and everyone abandons, ship. And we have, aspects of that right now kind of going on in our market with the AI euphoria that has swept through the market, very similar to, the dot-com euphoria in the late 90s. But in the late 90s, people were actually investing a lot of money in companies that didn't even have revenue. Forget about profit. They didn't even have revenue.
Yes.
So at least we've come a long way since then, So now we invest in, companies that maybe don't have profit, but at least they have really substantial revenues, and we're just looking for their profitable, mark. But, so that I think is a mark of progress. But so definitely profit is I think a dividing line between the investor and the speculator. The investor really does care about that. However, investors will make investments in companies that are pre-profit, and they are making projections, on what is this timeline that this company that's pre-profit will turn a profit. And once they do, there's a real exciting event on the other end of that for the valuation. So again, here I am trying to create a distinction between the investor and the speculator, but there's actually that actually isn't a great representation of it. But someone like Buffett wouldn't touch a pre-profit company, or really is unlikely to do that. They want to see established earnings. They want to see an established growth rate for those earnings over a period of time, and they want to understand the management team of that business. And when they're making a capital allocation, it's really a vote of confidence in the management team. It's a vote of confidence in the trajectory of that business, and they're really along for the ride. They're really attaching themselves to that narrative and that story as it plays out. And that's a long-term game. And along the way, maybe management's making some very good decisions, whether it's acquisition decisions, whether it's product line, whether it's new markets that they're opening up into, distributing into. Those are all happy surprises along this long-term investment journey. And the speculator, that really isn't the approach of a speculator. A speculator would look more at it as when will the market recognize the thing that I'm recognizing? I see this obscure opportunity, and it could be something out of left field, and I think this could happen, so I'm going to allocate money into this. And then maybe other people have the same idea. And then if enough other people have the same idea or may see the same opportunity, then there'll be a flood of buyers. And then I can sell it to those other people that saw the thing after I saw the thing. And that's an interesting way to be in the market. And by the way, the capital markets need both. You need investors and you need speculators. Speculators provide something that investors don't provide to the market, and that's liquidity. And so I think this is another, part of the discussion that gets glossed over quite a bit, which is that, speculating is bad and investing is good. That's not true at all. If everyone was an investor that participated in the capital markets, we'd have a lot of problems. The markets would be highly illiquid. Nobody would be selling anything ever. They're just holding on to things, until they're in their late 90s, like Buffett. And it's like, sell some things so someone can buy it, man. I mean, it's like, we want a little piece. So you actually do need speculators to create this liquidity and have a hypothesis of something, some reason to jump into an opportunity and then also to exit it. And I think that's what makes the capital market so very interesting, is this wide variety of understanding, of perception, of opportunities. And that is it's such a disparate display every day. I mean, you just turn on any business media any day, any hour, and it's like, it's pure entertainment, in the individual moment that you're watching something. And of course, the danger is really subscribing to whatever's being broadcast to you in that moment, because you don't have broader context to evaluate it.
Absolutely.
And so that's where you get into really more of the professional investor mindset. When you're running a strategy at scale, when you have investors that are allocating capital to that strategy, you really have to develop, I think, not only very thick skin, but also guardrails around your discipline and your thinking on that discipline. And so even at my own firm, I've had to do that very consciously, to not even read the papers from certain economists that I tend to agree with a lot. And so I don't want to read them all the time, because then it becomes an echo chamber.
Yeah.
And so I instead am looking for opinions that from people that I really I don't understand how they think the way they think at all. And I really favor, consuming that kind of information, because once in a while I can actually get a perspective on something that I hadn't thought about it in that way. And that's the most difficult thing, I think, about really any profession or any pursuit, is trying to look at opportunities in a different way than how you would normally choose to look at it or evaluate it, because we're only in our own minds. We're only in our own, I only look out of my eyeballs.
Yes.
And so it's very hard to develop a discipline to look at it from other perspectives. Truly, you actually have to protect your input, and that's really very interesting to me.
I love that about you, Ivan. I mean, the few conversations we've had, I see you go very deep and you welcome broader perspectives. I love that. And really, really well said. I mean, we could all do better with that. So I've got, and there's no answer on this one necessarily, right? But if speculators, and I guess this is a bit of the elephant in the room question, if speculators in the long term actually have a net gain in the long term? Because you mentioned the roulette, the analogy you gave earlier at the beginning. And so, people are kind of speculate. I mean, they've got their thesis and so forth, right? Whereas, you've got the investors who are a little bit more kind of, they got a thesis and it's thought out and it's a long-term plan. Does the house win or not win in the long term when it comes to speculating?
That's an excellent question, because you're tying it to the gambling analogy. And so if someone is only ever speculating,
Yes,
and never really investing, if you can create this delineation and say that a speculator is just looking for, short-term price movements and opportunities based on very little research or thesis, versus an investor who has a longer term perspective, has more of a thesis and an understanding. The speculator is more likely to suffer the consequences of market volatility. They're more subject to it. They're more vulnerable to it. And because the underlying thesis is by design not meant to be highly developed with a speculator, it's more of a play based on some very superficial observation, if even that. But usually there's a superficial observation, a market dynamic, a supply and demand item, and that will be the reason to make the trade. There's too many of those opportunities in a day, in a week, in a month, in a year, that they can almost cancel each other out.
Yeah.
And you really are vulnerable to that as a speculator when you're only speculating. And so if you do, and I know, you have sort of questions around, the idea of like there being a usefulness to speculators. Yes, we know there's a usefulness to speculators in the marketplace because they create liquidity.
Yeah.
But they may do so to their own detriment.
Yes.
Over the long term. And so ideally, a great speculator has success in a speculation and then carves off a piece of that profit and becomes an investor.
I love that. I love that, Ivan. There you go. There you go. Please keep going.
Yeah. And so in that way, you could actually be both. And sometimes there is great, sometimes you just can't deny the observation that you make in the market. And you wait for, so you have a thesis of why you're waiting for an entry point to get into a particular piece of the market. And then for whatever reason, it manifests. It usually manifests in a way that you did not predict, by the way. But you still got the result, and the price is what you want. So you have to take action. You have to make the allocation because this was the thesis. I'm going to buy in. This is the discipline. I'm going to buy in when it hits this price. You really don't care why it gets to that price. I mean, apart from, some corporate malfeasance or, some accounting issue or what have you. I mean, but all things being equal, you make the allocation. And then the price moves over a couple of years to a target return that's very fair and what you were really hoping for. Well, now you have to exit it. It's a discipline. And that's, I think, part of where like an investor enforces their discipline.
Yeah.
They monitor a discipline. They first of all have to develop a discipline.
Yes.
Over time, which is the only way to really do it with real money, not fictitious money and fictitious portfolios. It has to be because that's the thing. It's like a lot of beginning investors or a lot of these college courses or different programs. It deals with fictional money. You have no emotional attachment to it. But when it's real money, oh my God, it doesn't matter how much it is. You're like your whole heart and soul is in that $100. In that $1,000, whatever it is, it's like, oh my God, this is real now. And it completely changes the experience. And so that's why I think it's great that you have this advent of, so many millennials and Gen Z. I mean, so many people in the market through these very low cost entry points, brokerage, mobile devices, and where they can buy fractional shares of a stock but with real money. And so they're going to learn very quickly lessons. Hopefully they're learning lessons. But speculating it's hard to learn from speculating. Only speculating.
Absolutely.
Because you're really humbled again and again and again in ways that you couldn't have imagined. It's like, oh, this is a great investment. Of course, I'm going to do this. I'm going to put some money over here. I'm going to make some money. And you do that and you're just humbled, well before that you thought you would have. And you should learn from that. You should take that in and say, okay, maybe I need to change my speculating discipline or my speculating process. Maybe I need to identify different things to make myself a better speculator. And maybe that's where market technicians come from. They're like trying to now really read the tea leaves on what's happening in supply and demand of market conditions. Or maybe it inspires you to really become an investor and say, forget the speculating thing. Let me just put my money in companies that make money, and maybe they grow over time because they have good management teams and they're making good decisions for how they're serving their consumers and how they're developing and delivering product to meet that need. And and I think both are interesting and both are necessary, in the market.
If you had advice at this point, because you raise an excellent point, Ivan, for the young 18 to 25-year-old who's following meme stocks and stuff that's going with social media, and we live in a society of immediate gratification, we all know that. What would your advice be?
Well, I mean, I was a 13-year-old trading my college fund,
Yes.
and I had no fear. I could happily put all my eggs in one basket for a day, and I made money. I found I developed a little system.
Yes.
And I kind of followed my system, and I never got too greedy, and so that was my conscious way of trying to figure out how to make money in the stock market. Very, very challenging. You have to identify, you have to really be clear on what your system is.
Yes.
What your process is, and you have to reinforce that, because you're going to be tempted to ignore it and just let a good thing keep going. And then, of course, that's when the bad thing happens, usually. So you can't be too greedy. It's like pigs get fed, hogs get slaughtered.
Yes. Yeah.
It's one of my favorite, comments on in the with people that do get too greedy. But I would say, a young person should be an investor first and dabble in speculation second. Because also there's something powerful about compound interest, compound returns. It is truly a magical mathematical phenomenon. And it's very, very hard to get back time.
Yes.
As a matter of fact, it's impossible to get back time.
Yes.
But you don't realize how valuable it was until you're more advanced in age. And so putting away small amounts of money, very small amounts of money at a very young age can build to extraordinary values. Even just doing something as simple as an index fund and just investing in an index fund on a dollar cost averaging basis every month, whatever, $50, $100. It's like people go and blow $100 in on 3 drinks in Los Angeles. It's nothing. Anybody can commit to $100 a month type investment plans, but not everyone does. Very few actually do. And yet you'll never get back, between the ages of 16 to 30. Wow. Putting away that kind of money for that amount of time in an index fund is some extraordinary figure at the end of that period. And maybe you got enough money now for a down payment on a house or whatever. I mean, you have a lot of options. Having money just gives you options. So the earlier you kind of realize, I can kind of do this. And certainly people that are very diligent to save in their 401k plans that the company offers, and the company matches some deposit amount, and are very diligent. I mean, that's what my father did. He worked 40 years in a career and he saved his money in 401k plans. And he was very smart to hire his son as his financial advisor very early on in his career. And you know, he's living the life of he's a happy guy. You know,
Yeah.
he's a very happy guy. He doesn't have to think about investing, and but he knows how to save. He knew how to allocate the money, and he was a max out the 401k contribution type person his whole career, which is extraordinary. You know, that really takes discipline, because it means there's a lot of things you're not going to be able to do this year or next year because you're committing to this future. And maybe that's too extreme, you know. So I'm not suggesting that people need to be one extreme or the other, but find some kind of routine to commit to, you know, something really basic. And then all of a sudden you realize, oh, this money's coming out of my account. I didn't notice it. Maybe I can up it a little bit. And that's when things start to get very interesting. You know, you all of a sudden wake up one day and you see, oh, wow, I've got a lot of money over here. That's nice. I have options now. Do I really like my career path? Do I really like the home I'm in or my living situation? Or, you know, it's like all of a sudden, if you have a pile of money and you're young, maybe you want to do something that you couldn't otherwise do without that pile of money. You want to pursue a business, you have an idea, you know, so it is the ultimate thing as a young person to start doing it as early as possible, because that's also when you have the most energy and you have the most ideas, and also very little consequence of failure when you're young. And so, but you do need money to pursue dreams and ambitions. But you don't necessarily need a lot of money.
You said it a few times, Ivan, beautifully about the discipline and just being very disciplined. How does, and I guess at each stage of life, we just talked about youngsters and his quote unquote middle age, and then more horizon years. How does one think about that discipline and understand what their unique discipline is? Because you said, look, we could have a mix of investing and speculation. There's nothing wrong either way. When you're looking at long term, maybe more investing than short term, but you've got to understand your discipline. How do you acquire that discipline? Where do you get that from to kind of discover your unique discipline that works for you?
That's a very good question, and I think it will vary based on the individual.
Yeah.
And so, a typical investor, retail investor, who's just looking to make good decisions for their future, you know, a good discipline that they can develop really means maybe not looking at their statements. Maybe look at them quarterly, not daily on the mobile app. Assuming that there is an investment
Yeah.
strategy in place.
Yeah.
You know, if you're a speculator, you're going to want to look at it every 2 minutes
Yes.
or every 20 seconds. You know, so you're kind of going to have to identify which discipline are you trying to really develop. But if you're looking to develop more of an investor discipline, it means distancing yourself from the flow of information. And when I started in this business, you know, we had the internet. It was just at the beginning, but you know, we got newspapers delivered to the house every morning. I would read 5 different, you know, beautiful newspapers printed on different colored paper. And, you know, it's like, I remember the tactile experience of reading newspapers every morning, but that's all you got. You got one paper in the morning from different sources, and then that was your news for the day. You had to digest that information. You got to maybe even revisit an article. You carried around the paper with you all day. You kept it at the desk all day. And so, I think I saw something about that. Let me go look at it. I mean, it was really like a reference tool. Now you have a flow of information that's being updated throughout the day. I mean, even on your iPad or whatever device you're using, you go and you look at it, and it's new news for the day. You know, you can look at the print edition under the special section of the app so you can see what was actually printed. So I always look at the print edition because I'm like, well, that's the important news. The important news is the one that they actually decided to spend money on putting on paper, printing ink, put all this money to produce the actual print. That's the important news. So let's see what makes the print edition tomorrow. I really don't need to know all the noise during the day. Is that going to change what I'm doing right now? No. There's no news that can be delivered to me right now today that will change anything that's going on in any strategy we're implementing. There really isn't. I mean, if we haven't thought about it, then that's shame on us. Then that will reflect in our performance. It will reflect in the results. But that's the test of it. So you have to find ways to consume information that are actionable, but most information is not actionable. And I think this is like the big discovery for maybe a lot of young people who were born with a mobile device in their hand. This constant flow of information is not useful. It isn't helpful. It doesn't make you smarter. It doesn't make you wiser. It just makes you more current on like every little piece of minutia, but it doesn't mean anything. And I think this is like the actual, like real intellectual epidemic that we have in the world, which is this confusion that more information provides better decision making. That's not correct. More information does not beget better decisions. Asking better questions begets making better decisions. But how do you develop an ability to ask better questions? It means you have to have deep thinking and understanding of things. And there's no way to do deep thinking and develop understanding if you're constantly consuming information. It is a physical impossibility of the human brain. You cannot be intaking information and at the very same time deep think about that information, because there's a barrage coming at you. And that, I think, we don't talk about enough in our society, certainly in the capital markets and business. People don't talk about that. It's all about, here's this information, here's this news. What do we do about this? You hear the journalists all the time, this just in, breaking news. And they turn to, someone on the panel and they say, well, how do you react to that? And that person to me, oh, well, this is a symptom of the, like, wait, you don't have any opinion about this. You're just making it all up right now. Like, and they know that. Everyone kind of knows that. Like, it's all just for show. But, the typical consumer, the retail investor, certainly doesn't know that it's all just a fiction. It's all just entertainment. They actually go back to their office and, the good ones, they're thinking very deeply about things for hours a day. Even in my daily schedule, I have a period of time where I consume news and I look at research and I look at data, and then I have at least 2 hours a day where I think deeply on all of the things that I've been consuming. I mean, and what does that even look like? I mean, I guess you could ask team members. It's, maybe look strange. I could look out the window. Maybe I listen to some classical music. Maybe I read, something not business related. Yeah. Medical journals are really fun. I like reading medical journals. Very interesting. It's like, wow, all these interesting things happening over there. But don't read stuff in your field. Read something in someone else's field, and not just light stuff, but technical journals. It's fascinating, and it really inspires your mind to try to think about things differently.
Absolutely. I love that. That's a drop the mic moment, without a doubt. I mean, that's fantastic. More curiosity, deeper thinking, broader scope in terms of, knowledge collection. I've always thought one thing, I love your perspective on this. I had my 2 boys do this at a young age because they were early investors. I told him, I said, whatever it is, if it's the Wall Street Journal or any one of the business newspapers, you have to learn economics 101.
Right.
You have to,
Oh, yes.
because none of this stuff is going to make sense when you listen to the news or you read the papers or whatever it was. And I'm a proponent that anyone, rather than listen to stuff that's going on in social media and going with the trends and the tidal wave and all that kind of stuff, absolutely before you push a button on one of those mobile devices, learn a little bit about basic economics so you can make a decision of some sort that's a bit more informed.
Phenomenal. It's your kids are very lucky to have gotten that advice, because people hear economics and they immediately turn off. It's like, oh, they actually, even the industry itself called it the dismal science. So even the industry has judged it as just a very boring conversation. For me, that wasn't my experience. When I first got exposed to economics was through my grandfather, who was the Undersecretary of the Treasury of Cuba.
Yeah.
And so when I got introduced to economics, it was because Che Guevara put a gun to my grandfather's head and said, sign economic policy, sign this economic policy. It's good for Cuba. And my grandfather, he would say to me, Ivancito, I had a pen, he had a gun, so I signed. And so I thought from a very young age that economics was something that you could die from if you were on the wrong side of it.
Yeah.
Like a 7-year-old, kid, 8-year-old kid. Like I didn't really understand like but that was a very visceral example of how black or white, right or wrong, life or death, economics, and your beliefs and understanding about economics can actually lead to your death imminently.
Yeah.
It's obviously an extreme example, but wow, that really woke me up and it scared the hell out of me. So that was my impetus for wanting to understand it. But of course, once you start studying economics very, very deeply, not just the 101, which is incredibly valuable, like there's no replacement for understanding, like, what does the central bank do?
Yeah.
Like once you start once you have a basic knowledge of what the central bank does, I think that scares the heck out of you.
Yeah.
Like immediately you're paralyzed with fear. That's certainly my feeling of it. Like you learn that this concept of a fractional banking system globally is just all made up. It's a faith that we have as a civilization. And that was not always the way it was in our human history. This is a very recent phenomenon. For most of human history, we had pieces of metal that were shiny and pretty that would pass from one hand into another person's hand. Most of human history. And now it's all in the ether, and money is created out of thin air. That is actually how the central bank creates money. It's a little bit more fancy than that. It's like the Treasury knows that they've got to issue a certain amount of debt to meet the Federal Reserve's buying. It's a complete fiction. And so why you get crises, why you get economic downturns, depressions, recessions, bull markets, bubbles, and the cyclicality in our economy is all derivative from our economic system. And so, boy, it helps if you have an understanding of economics. All of a sudden, things make sense to you. Like, why? Whoa, I bought this thing. Why did it collapse? Well, maybe because it never made any money. Maybe that has something to do with it. I don't know. Call me crazy.
I think it's a fabulous conversation. Ivan, we can go on for hours, and you hit exactly on the next point, which is how does speculation influence market bubbles and crashes compared to traditional investment strategies?
Oh, I love them. I love speculators, and I tell clients, I tell our team members all the time. I said, I love it when we buy something that a speculator sold. Like like they're beaten up, they've lost in their mind,
Yes.
and then they get rid of it. I'm like, oh, finally, now we get to buy the thing. So we need them to make bad decisions all the time.
Interesting.
Like that's our lifeblood. Like that is an investor's lifeblood, is bad decision making by speculators. You like if no like my point earlier, if no one ever sold, we would never be able to buy anything. And so they need to lose confidence in things so that we finally have an entry point that we are confident in.
Love that. I love that, Ivan. Wow. Wonderful. Okay. Are there certain financial products, Ivan, that lend themselves more to speculation than investment? And can you give a couple of examples?
Yeah, I would say things like, I mean, cryptocurrency is obviously such a huge topic, and the opinions are highly a huge span of opinions around it. But I would say it falls squarely in the speculative category. Cryptocurrency itself, not the blockchain technology underneath of it. That's a complete tokenization, blockchain. That's a completely different thing than currencies from blockchain. And the reason why I see it as so incredibly speculative is because we do have a central banking network throughout this world. And so I've always posited that if you're really going to see value in cryptocurrency, it requires the complete deleveraging of the global economy through the central banks in order to do that. That is almost an impossibility without a huge, enormous capital destruction event, like a global world war or a global economic crisis that you can never recover from. And so in those instances, there actually is great value to cryptocurrency, because it becomes more like that shiny piece of metal that civilization used for so many millennia. But it seems so unlikely that we'll get to that moment. But what if we do? And so that is a speculation. When you get into foreign exchange, Forex, that there's a lot of volatility there because it's all made up. Currency demands have only a few pulleys attached to them, mostly trade and also the central bankers' activity around that local economy. And so you can be blindsided by all kinds of strange things that happen to a particular currency, and currency can move very quickly up or down in relation to other currencies. And I would say options. There's a lot of people that like options trading. That's highly speculative. You're not an investor really if you're using options. You could be, but you're more of a speculator because you're limiting your loss, you're limiting your upside. There's very specific strategies, on how you're making a play. Really, derivatives of any kind, are really speculative tools, the tools of a speculator. Futures contracts, also the tool of that's a classic speculator or a hedger, someone who, has airline companies do this all the time, of course. They have huge need for oil, jet fuel, and so they're going to buy. This was something that made Southwest Airlines, I think it was 15 years ago, made them so profitable because they hedged like 3 or 5 years worth of their consumption of oil.
Yeah.
And the price of oil went through the roof, and this airline already bought all the oil needs and jet fuel needs for years to come. I mean, what a brilliant move that was from their CFO. No one's ever seen an airline do that since, and no one's been able to do it since. But, that's a speculation that actually was a very good investment in hindsight. Did I answer the question?
I think so. No, I think that's a good one. Let's go to what role do leverage and margin play in speculating versus traditional investing? Because this is a tough one unless you really understand what you're getting into when you're leveraging and
Oh yeah.
you're buying on margin. The audience needs to understand this.
Well, anytime you introduce debt into any financial transaction, it is an exponential increase of risk,
Yeah,
not just an arithmetic increase or a geometric increase. It is an exponential increase of risk. And so very dangerous, because you can get highly unprofitable very, very quickly. And certainly this is what a lot of hedge funds do. They're sometimes, leveraged 10 times over. This is what also made the great financial crisis so awful and painful, was because there was so much leverage in the system on assets that were improperly characterized as quality assets, and they were actually all junk assets and leveraged multiple times. So it created this behemoth destructive force from within the system. And of course, if it can do that for a big system, financial system, it can do that for someone's individual account very, very quickly and very, very easily. So using margin is extremely dangerous when you're borrowing in order to buy more.
yeah,
Wow, that's incredibly dangerous. And you don't really need to do that if you're already speculating on the price movement of something that you're buying. You're already going to win nicely if you're right. You don't need to amplify that win with something that can wipe you out entirely. I mean, beyond just the value of the account, it can wipe you out personally, because the borrower, the lender, is going to show up and say, well, you wiped out everything over here. Now we need you to put in all this money from somewhere else. Well, I don't have it. Well, now all of a sudden you're a debtor and you're going to have to come up with the money. So it's very, very dangerous to use margin or any kind of borrowing for amplifying your returns.
understand. Okay. All right. For listeners who wants to transition from speculative trading to more investment focused approach, how would you recommend educating someone who wants to make that transition?
Well, I think the first thing is, you have to kind of resign yourself to excitement and the lack of it.
Yeah.
I think of it's more of a behavioral shift for someone, because all that energy, all that time, all that focus and interest in keeping current and consuming news and information and placing importance on figures and graphs and charts and believing that you're creating value by doing all of that in a very concentrated time frame, you have to kind of stop believing all that. And I think it's a very welcome thing for people that realize, oh, this is a very, like, what always amazes me is people who get to retirement and then they want to like invest their own money and day trade. And to me, that's just like, why would you ever want to do that? Like, that is the worst possible retirement I could ever imagine for any. It's worse than a jail cell. I mean, it is a jail cell of your own making. And yet there are people that do that, and not a lot of, the vast majority of Americans still do not hire a financial advisor. Most people still do it themselves because, and that's a whole other subject matter, but financial advisors, unfortunately, most of them don't have the ability to show their track record of decision making for their clients. They can't show their performance history. And so that has naturally meant that most investors cannot trust the service that they would be offered from an advisor. And this is why our firm has made that such an important focus of its deliverables, is to actually maintain a historical track record and meet all of the very rigorous requirements and compliance in order to do that. For good or for bad, the track record is the track record. And so that allows somebody to have a little bit more confidence in hiring you. But, the vast majority, over 95% of advisors in the marketplace don't have that are serving retail investors. So I think that's the biggest thing for an investor is they have to find other things to do with their time and develop a really great hobby. Pick up golf. I mean, I never was good at golf. I hate golf to this day. But boy, if you really want to challenge yourself to get away from speculating and trying to find winners in your portfolio, you go hire a golf pro and just be humbled for hours a day, and then you'll forget very quickly about being a speculator.
Awesome. All right, and we're going nicely into this point. It's really around long-term goals, Ivan, and wealth preservation. So in your opinion, how does each approach impact long-term wealth preservation and growth?
Well, there's a lot of people that have made a lot of money from speculation. And so you just can't deny it. Certainly we have clients who have, they started a venture, but it was their own venture and it eventually became profitable, and then it got bought by somebody else and they had a windfall amount of money, and they were smart enough to say, okay, well, I have no idea how to play the markets. I don't want to become a speculator. I need to hire somebody to do this and make sure I don't run out of money before I pass away. That's the goal. And so in a very real way, speculation actually created that wealth, for that individual. However, to maintain the wealth, you can't really continue to do that in a different format.
Yeah.
And I think that's also the interesting dynamic with this is quite a bit of wealth is created through speculation, but it is because it's a personal venture. It's a business venture.
Yes.
And that venture itself is actually worth quite a bit. But it's highly speculative. But you're putting a lot of your own sweat equity into it. You're putting your beliefs. You're putting, it is your occupation. But to try and translate that speculative behavior into the capital markets, I think that's an error, because the capital markets don't reward speculation the way that it does with a business venture, which still has a very high possibility of failure.
Yeah.
But you actually have much more potential for success when speculating on yourself through a business venture than you do in going to the capital markets and speculating. Think of that from a statistical standpoint. And the statistics are terrible, for starting your own venture. Yes. So imagine how terrible they are when trying to speculate successfully in the capital markets.
Great point. Okay, so how do you encourage clients to remain focused on their long-term investment objectives amidst the temptation to speculate?
Well, I think understanding what is the strategy that is employed currently in their accounts.
Yes.
Every client, every investor should understand at a very basic level what the strategy is for their account at that moment. And if they can't really answer it in a couple of sentences, they maybe should talk to somebody to get some perspective, because that's going to matter when things get dicey, when the news starts to get scary sounding and the market, the index is dropping 10 or 20%. All of those things trigger our, flight or fight response in our amygdala brain, in our, Neanderthal brain. So we go nuts and we'll make bad decisions if we don't already have a framework to evaluate that incoming information. And so we make sure, every client of ours just has a basic understanding of what do we believe about the stock market right now? What do we believe about the bond market? What do we believe about cash? That's it. We like any of those more or less, and why, and just be able to summarize that in a couple of minutes. That's valuable to someone, because then that's like an anchor. The more simple, the more density that information has, which has more weight. And then it keeps you seated, it keeps you balanced. When you have information that isn't very valuable, then you're just aloft. You're going to get blown around based on, whatever's blaring at you at the moment. And so for me, it's about the density of the information, the specificity of it, how clear is it? And so that's why I think, a lot of financial advisors have a lot of work to do in that respect. You just can't say diversification is the only free lunch in the capital markets. Yes, that's true, but that's an axiom that everyone kind of accepts. Let's dig a little deeper.
Yeah.
How am I prepared for what's coming next in the stock market? What does my portfolio believe is going to happen next in the stock market? That's a great question to ask. Anyone that has a portfolio or an account should be able to ask the question, what does my portfolio believe is going to happen next? Because it already is committed. The capital's committed. So it has a belief. And anyone that's, advising that client should be able to make a statement. You believe that it doesn't matter. Like a lot of advisors would say that it doesn't matter what happens next because you have a well-diversified portfolio and we'll just rebalance in whatever happens next. Or maybe you have an advisor that does take a lot of ownership and authority in what's happening and says, well, you don't have any exposure to large cap growth companies in this portfolio. Therefore, where there's this massive amount of concentration risk in the S&P 500, where the top 10 stocks represent, 30-something% of that entire index, you don't own that. So if that index drops 30-40% tomorrow, your portfolio doesn't have that explicit exposure. So that's how it's prepared today. That's what your portfolio is saying today. It's willing to give up upside in order to avoid the downside risk associated with that particular characteristic. And so I think that's very important for people to understand. What story is your portfolio telling you today?
I love that, Ivan. I absolutely love that. That is just superb advice, man. I love that. That's one big question I think all of us can benefit from. That's a great question. Love it. Thank you.
Yeah,
That's a real
absolutely.
wisdom bite, man. In amongst everything, that's a
Yeah, my
big
pleasure.
one. That's
Yeah.
a big one, Ivan. All right, final thoughts. With the rise of technology and access to real-time trading apps, do you think speculation has become more mainstream, and what are the risks?
I for sure it's become more mainstream, but I also think there's a benefit because it's exposed people to the capital markets in a much more basic way, very easy way to participate. And it's okay to lose money in the capital markets as long as you're learning from those losses. It's like love. It's like if you never date anybody, you're never going to get married. You're never going to find the one to be with for the rest of your life, or at least one of the ones that you'll be with for the entirety of your life, considering 50% of marriages end in divorce. So if you get into the markets and you lose money and you lose more money and you lose more money, maybe one day you wake up and you say, you know what? I'm tired of losing money. Maybe I should get some advice, or maybe I should do something different. And also it's about being very honest about your losses. Because unfortunately, people, the studies around it are fascinating from a behavioral finance standpoint. People hate their losses 3 times more than they enjoy their gains. And so they completely block out the losses. And so, we meet a client and we ask about their investing experience, and we want to know, what's been their journey up till now that we're meeting them. Have they worked with advisors? Have they been investing themselves? People are always very excited to share their success stories of investing. But when you ask, well, what about the losses? Oh, I've never lost any money in the market. Then why are you here? Why are we not hiring you to become a portfolio manager and run one of our strategies? Like, we don't have a monopoly on good ideas. If you've never lost money in the markets, we need you. Like, Join our forces now, please. And then and I do say this, by the way, to people, and they'll look at me like, is he joking? Is he I am not joking. Like, I will hire you right now. Like, if you never lost money. And then they kind of get it, well, I guess I have
Yeah.
lost money. Okay, now we're getting somewhere. So, but this is the reality of how we compartmentalize losses. And so it is great that people have these easy entry points into the market, but the point is to learn from the experience that you are actually receiving from it and start small so that it doesn't have a grave consequence to, your groceries. Like, you need to be able to eat and put a roof over your head. Don't overdo it. Be very limited. And thankfully, these applications allow for very low and easy access points to at least begin learning something. But you have to be open to the education that you're going to get.
Awesome. Awesome. Before the last question, Ivan, what question should I have asked you that I didn't?
Do I sleep well at night?
That's a good question. Do you?
I do. I do. I sleep. It's something I've always valued very, very highly, is getting 8 hours of sleep every night. And of course, it's very difficult to do that when you're traveling around the world and you're, and you've got business to run, and it's like, so 8 hours is like, wow, what an amazing night that is. It's like time travel. But I do value it, and I certainly, for me, it's about not worrying about how we're invested. And I think this is the most important thing about a discipline, is the main benefit that you get by having a discipline is that it actually eliminates worry.
Yes. Yes.
Because you've invested so much time and thought and just perspective in developing a real discipline of how do you process things? How do you make decisions? What's the framework of decision making? Once you have that, and it's become your companion along this journey, now you really don't worry about anything anymore, because it's been part of the process. And you've really tried as best as you can with all of that perspective to create something that is prepared for whatever may come next. But you still have an opinion about what's coming next. And I think that's incredibly valuable. The value of a discipline is extraordinary.
I love that. And what a way to almost close out this conversation. Great, 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 great endpoint there. So, final advice. Final advice to speculators and investors. What would be your final wrap-up advice, Ivan?
Well, I would say don't come to the conclusion that one is better than the other.
Yep.
They both have value in the capital markets. But if you're looking to really excel your participation in the capital markets, evolve your participation, I would say, in the capital markets, be a better student to understand when are you acting as a speculator versus acting as an investor. And don't try and delude yourself. Be very honest about it. There's nothing wrong with either one. Just be very clear about which one you are, and learn from that experience. If you're having sequentially bad experiences in one way versus another way, that's information that you should be listening to and reacting to and making changes in your life and in your decision making as a result of it. It's the classic definition of insanity is doing the same thing over again, expecting a different result. And I find this to be very, very, very typical in the capital markets and the market participants. People keep doing the same thing, and they're just, expecting that. I mean, that is where it is very identical to going to Vegas and putting it on the same number, every time at the roulette table. And you're like, well, it's going to hit, it's going to hit, it's going to hit. And it's like, wow, I mean, are they going to lose everything just thinking that this thing's going to happen? And yeah, some of them do. And that's very, very dangerous. And I think in the capital markets, you do see that. You do find that. And it's very, very discouraging. And you don't need to lose all your money to learn a lesson. Start very, very small. Be excited. It's good to be excited in the capital markets, but let it be a teacher to you and be open to what it has to teach you. And it is an educator. It is very much interested in humiliating and humbling you at every moment. And so if you're open to that, you can actually be quite successful.
That is brilliant. Ivan, thank you so much. What tremendous wisdom bites throughout this entire hour or so that we've had together. Some real golden nuggets. And I personally want to thank you, Ivan. We've had some great conversations, some deep ones. I can tell that you are a very, very deep thinker. We've had some interesting discussions and debates. This is really, really cool. And you know, what you're doing to elevate humanity is just fabulous. Ivan, I mean that sincerely. You know, as part of your life design, you know, managing finances is everyone's business around the world, right? I mean, and what you're doing to educate communities and the public is fantastic with your best-selling book, and the way you educate and being part of the Forbes Council. Thank you for everything you're doing. It's fantastic.
My great pleasure, Richard. And, you know, like I say in most things, it's knowing what questions to ask that actually are the most important thing. And you have just great questions. You actually seek to understand, and that's very apparent. So I really appreciate the time with you today.
Thank you very much, Ivan. Absolute pleasure. Awesome. All the very best to you now.
Thank
Bye-bye.
you. You too.